Hey guys, it's Konrad Bobilak here, CEO of Investors Prime Real Estate and best-selling author of Australian Real Estate Investing Made Simple. Welcome to today's video. There's a lot of doom and gloom in the media at the moment, and a lot of it is justifiable, especially when it comes to inflation and the pressure that it's put onto a lot of families just to survive, especially the middle and low income earners have been hit the hardest. Not only is food getting expensive and fuel's getting expensive, but also rentals have escalated to a point that we've never seen before. And I've definitely never seen this level of escalation in all my 25 years of investing in the Melbourne property market. But I wanted to make a video today to talk about some of the positive things that are happening in the market, because despite all the doom and gloom, there's actually a perfect storm has developed in the Melbourne property market. Some of it has been developed by good things, others have been developed by bad things, but it's all accumulated to a point where people will make extraordinary amounts of money if they position themselves correctly from a structural perspective, so buying properties through trusts, controlling assets and owning assets, and also buying in the right areas as well. So welcome to today's video. Now, a bit about my background. I'm a real estate agent. I have a diploma in mortgage broking, real estate, financial planning, and a business course. But I'm also, the most important thing about myself is I'm actually a property investor with a multi-million-dollar property portfolio here in Melbourne. And this is what gives me the right to talk to you guys about what I'm about to talk to you about, because really, you can be an academic that's broke and have no results. And there's a lot of them out there, believe me. They've been prophesizing doom and gloom and Armageddon for the last 3 years, and look how strong the property market has been. In fact, it's just now turned the corner in the last few months and gone up by 0.6%, which is very predictable. Eventually, it's going to turn the corner. It's very cyclical. And the reality is there's an inefficiency, inequality between the supply that we're creating in the right suburbs and demand. And even right now, Melbourne is probably 100,000 homes short of where we should be. Remember, when migrants come in, they don't want to live in house or land estates in the middle of nowhere with no infrastructure. A lot of these migrants, when they move to established areas like Glen Waverley, Springvale, Bentley, areas where they have their own community. Not everyone wants to live 60, 100 k's from the city in a brand new house and land estate. So building houses in new house and land estates is not going to solve the problem of the housing shortage that we have in Melbourne and Sydney. Nothing will solve it, guys. It's the reality of life. It's always been expensive to live in Melbourne. It's going to get more expensive. People will always be out of pocket, and there'll be, unfortunately, a lot of income earners will be spending an extreme amount of their money annually towards their rental or mortgage repayments. It just is what it is. It's always been this way. I'm an author of 2 books, as I mentioned before. If you want to get a copy of my finance book, jump onto bookonfinance.com.au or Amazon or any good bookshop. Or if you want to get a copy of my last book, Real Estate Made Simple, jump onto realestateMadeSimple.com.au, Amazon, or any good bookshop. That's enough of my shameless self-promotion. By the way, I really want to thank you guys for supporting my book, because I've made it to #1 so many times on Amazon. It's literally every month I look at Amazon and I'm seeing my book there #1 or 2. So thank you for buying my books. I really appreciate it. Without you guys, it wouldn't be possible. Okay, let's talk about the 7 fundamental things that are creating a perfect storm right now in the Melbourne property market, and why every investor should be aware of it. The biggest thing is, I guess, is for me personally, population growth creates pressure on property prices in specific suburbs. Now, there's what really drives capital growth. It's very basic. The right demand by high income earners in the right area combined with a limited stock. So for example, rich people wanting to live in Port Melbourne, and there's no more Port Melbourne being created. It puts pressure on stock. There's very low volume of sales always in Port Melbourne. It's a great suburb, 3 k's from the city, on the beach, cafes, restaurants, it's all there, right? So you have rich people fighting for a limited amount of stock, and people hold on to properties for a long time in Port Melbourne. In fact, there's properties in Port Melbourne, if you look on RP data, especially beachfront properties, that haven't been listed on RP data or for sale for the last 50 years. Very tightly held suburb. The opposite is Point Cook. Unlimited supply and no demand by high income earners. It's just demand by low income earners. And you can have an unlimited amount of Point Cook. And remember, there is no golden mile in Point Cook. It's just Point Cook. Okay? So that's why Point Cook doesn't grow as fast as Port Melbourne. Now, definitely you get more value for money in Point Cook because you get a big block of land with a 5-bedroom house, where in Port Melbourne, you're lucky to get a 3-bedroom dwelling. I mean, most of the time it's a 2-bedroom dwelling. 5-bedroom houses go for millions of dollars, obviously. Despite that, the biggest driver beyond that is population growth and having people coming over from overseas, fighting for what's already a very competitive market. Now, what has happened recently is a number of things, and they're all kind of happening at the same time, which is very interesting. Number one is Chinese buyers are back buying up real estate in Melbourne and Sydney. In fact, the latest figures show us we've pretty much become the #1 destination in the world for Chinese money. And in 2021-22, the amount they invested was 2.4 billion. Now it's 2.7 billion. Is that a significant amount of properties? No, it's not. It's a drop in the ocean, but it's something. Everything contributed to the bottom line. So if you've got people buying up brand new apartments, brand new house and land packages, you're competing with the local market. And even creating new house and land estates is still very competitive because there's bureaucracy involved. You can't just get a subdivision approved in 1 week. These things take decades and years to get approved from council. So we have Chinese money coming back to some extent, diminishing the volume that's available for locals, definitely. Melbourne has become pretty much the most popular city by destination as well in 22. So inbound inquiries show that Melbourne was basically 28% of all major searches on the realestate.com. So Melbourne has become the most livable city, the most sought after city because it's livable, it's affordable compared to Sydney, and it has all the jobs. And especially for migrants, when you look at skilled migrants that are coming in from China and India, which is a lot of doctors and medical staff and biotech and obviously engineering and everything else that we get to choose. 57% of them will be coming to Melbourne and Sydney. There's 650,000 on the cards to come through in the next 2 years. A lot of them will settle in Melbourne and Sydney because that's where the jobs are, that's where the community is, and that's where the job opportunities are. And also, for those families, schooling is very important. If you look at the best schools in Australia, most of them are in Melbourne and Sydney as well. You can't replicate a Scotch college, which has over 100 years of culture in the school. So you have all the Anglican and Catholic schools, which have the best reputations for delivering not only the highest TR score, but instilling a culture in a person that you can't replicate in other areas. Let's face it, guys, house to land estates have shit schools, and they're always going to be shit. That's the reality. You can't replicate something from Port Melbourne or Toorak or Brighton in a new estate. It's not going to happen. 100 years from now will happen, but you're going to be dead by then. So what do you care, right? Now, the reason I'm telling you this is I'm not doing a YouTube video based on schools. I'm telling you this because the best school zones also dictate the highest capital growth. And we've seen a strong correlation between school zones, private school zones, and public school zones that are ranked very high, attracting the right caliber of person into a suburb. So the only reason I'm telling you all this stuff is because I'm here to teach you how to make money out of property investing. I'm not here to get political about schools and why some areas have disadvantaged schools and why others don't. I don't care, okay? It's all about making money. So don't send me emails saying, I live in this area and you mentioned the schools are bad in the area. If I did, I was probably right. You can check it yourself online, okay? I wouldn't do it for no reason. I haven't got an agenda with schools. Number 3, Melbourne homeowners are holding back from listing properties in a declining market, resulting in almost 30% drop in the number of houses for sale in some regions year on year. Now, this is very interesting. See, because stamp duty is so expensive and because people have aspirational suburbs that they want to live in, once they get to that suburb, a lot of people will just stay put, especially during times of economic uncertainty. So these areas, for example, if you look at region and in terms of volume that's available right now, in the Melbourne, 21.9% less stock available this year compared to last year. In the East Melbourne, 14.4%. In the South, 28.1%, nearly 30% less stock available for sale this year compared to the same time last year. North East Melbourne, 28.2%. Northwest, 10.3%. Outer East Melbourne, 19.7, South East, 14.7, West Melbourne, 15.4, and Mornington Peninsula is actually up by 3.3 because there's been a lot of developments in Mornington Peninsula that have been released. Over 5 years, the story is pretty much the same, but look where we are. In the best areas, inner South Melbourne, for example, and same with outer Eastern Melbourne and South East Melbourne, which is where I'm predominantly sourcing, people are holding on to properties longer and longer and not selling. And they choose to do that because they have no mortgage stress. And this is a fundamental thing. If you look at the mortgages, like for example, let's take South Yarra versus Pakenham, most properties, houses I'm talking about, detached houses in South Yarra are paid off with no mortgage. In Pakenham, 99.9% of houses have a mortgage against properties, and a lot of them are geared up to 90%. So obviously they have different pressures compared to those people that are purchasing in South Yarra who choose to sell their house when they want to rather than when they are forced to because of economic circumstances beyond their control. So this will happen more and more. You're going to see people not only getting stock back on the market and withholding stock from the market, I should say, because they have to upgrade and live somewhere. You're going to see I guess a pattern of holding indefinitely in some key areas. So you're going to see suburbs like Canterbury, Hawthorn, Surrey Hills, definitely Elwood, Hampton, Sandringham, Blackrock, Brighton East, where people will just hold on to stock indefinitely. They'll hold properties for 50 years, they'll give it to the kids. So there's going to be less and less of volume available in those suburbs. And on top of that, a lot of these suburbs have restrictions in terms of what you can do to the block. They have height restrictions, density restrictions. A lot of them have single dwelling covenants, or they have a minimum land component. Like for example, in Brighton, you have to have 300 square metres now for a townhouse. Now the average block in Brighton is 594. So pretty much you've excluded most of the blocks for subdivision purposes. Now, there is an argument that Melbourne has the lowest per capita per kilometre of any city, major capital city in the world, but that's what makes Melbourne good. The moment you allow high density subdivisions in key suburbs, you destroy those suburbs. So I'm all for it. I'm for a balance of organic growth. But at the same time, we shouldn't be robbing people who work their asses off and end up buying a house in Canterbury to allow every house in Canterbury to be redeveloped. Because then the nature of Canterbury will be destroyed. You'll destroy the privacy, the exclusivity of the area. That's why it is Canterbury, because you have beautiful Victorian properties with rose gardens rather than 5 or 10 townhouses in every block. Now, I understand it's well located, but this is the reality of capitalism. Otherwise, we're going to, become a communist country where the government will dictate where you can live and what you can do? Well, we escaped that from Poland in '85. That's why we came to Australia. So there's a fine balance between housing policies, stock being created on the market. And this is the thing. There is no solution for the housing shortage in Australia. No matter what happens, I've been hearing this housing shortage, question since I arrived in '85. There's always been a shortage. It's always going to be expensive. Look, Australia is a great country, probably one of the greatest countries in the world to live in. Everyone wants to migrate here. It's multicultural. It's fairly accepting of all the alphabet people. And also, we haven't got major wars or terrorism in Australia. So, of course, people are going to be fighting to get into the best suburbs and the best streets and the best school zones. Why wouldn't they? And because of that, you have very high pressure on price points. It's not going to change. The only way it would change if we stopped migration from coming into the country, and then I would sell up my whole portfolio and do something else, because then the market would collapse. Melbourne has experienced record low vacancy rates. Now, just so you know, the average vacancy rates for a normal suburb should be between 4.5% to 6.5%, which means you have, 40, 50 properties available every week for rental in a normal suburb, whatever that definition of normality is. Now, when you have 6 properties available on the rental in a suburb like Armadale, you know that there's a critical shortage of stock, and you know there's going to be inefficiency in the market. There's going to be a lot of people fighting for the same property. And this is what we have at the moment, not only in Melbourne and Sydney and Brisbane, but even in coastal towns, there's a critical shortage of rental properties. Now, Airbnb has also cannibalised nearly 50% of the traditional rental market. So Airbnb is the biggest factor to blame for this critical shortage, because landlords can get much more rental by providing short-term accommodation than providing the traditional 12-month lease. So Airbnb, while I love Airbnb myself and I use it all the time, in fact, every holiday we've been to in the last probably 5 or 6 holidays has been through Airbnb, where I rent a house with a pool. Is it a good thing for the average suburb? Probably not. Probably it's creating more pressure on the rental market. And so I think there should be strict rules around which properties should be allowed to be on Airbnb and which shouldn't, because definitely we need to have housing solutions and affordability for certain sectors of society. The housing shortage has been, and the rental vacancy rate thing is incredible. Interest rates are up, people don't want to buy a house, they need to rent. They can't get into the rental market. Not only can they can't get into the rental market, rents have escalated to 30-40% in some areas. So now they're priced out of the rental market and they're priced out of the housing market. I mean, it's just ridiculously expensive now to live in Melbourne and Sydney. I tell people, look, if I was on an average income of, say, $100,000 a year, I think the average national wage is around the $98,000. I'll be going to Bendigo or Ballarat or Shepparton or a coastal town because it's just easier to have a mortgage there of $300,000-400,000 than trying to get $1 million house in Melbourne. $1 million in Melbourne buys you nothing now, you know. A normal house in a normal suburb is 1.5 million. Moorabbin is selling for 1.5 million, you know, like a nothing suburb. So, you know, the boring house is 1.2 to 1.5. A trophy home now is 2.5 plus, and you need 3 million for a decent house in a great suburb. So, you know, it is ridiculously high compared to what it was. It has gone up disproportionately high compared to wages. Wages have stagnated for the last 20 years, but that gives you the evidence, I guess, that real estate is somewhere you want to definitely be parking your money, you know. And this is why I've invested most of my money in real estate, apart from a small share portfolio in cryptocurrency. So in terms of Melbourne, there are suburbs that have gone up by 20%, but literally I know suburbs that have gone up by 40% in rental in 12 months, which is unheard of in the whole history of the suburb since it was developed originally. So we have now reached the point where properties are going from $700 a week to $1,000 a week. You know, we're going from $1,000 a week to $1,200, $1,300 a week, $1,400 a week in one jump, which is unheard of. Apartments are going from $400 to $600 a week, you know. It's just crazy what's happening out there. And I really feel sorry for those people who are on the breadline, who are struggling to keep a family afloat, and with fuel escalating and food and everything else, it's just incredible. Personally, I wouldn't, if I was in that situation, I'll just move out somewhere cheaper in the regional town, have a better quality of life. Now, also what's happening is, so you can see there, for example, Melbourne, December 22, the average for houses, the average rent was $480, where it was $470 in September 22 and December 21, $445. So it's gone up by 7.9%, 12.1 for Sydney and Brisbane, 14.6, Perth 15.2, Adelaide 11.1. So you can see combined capitals 14.6% annual change in rental increases. Now remember, normally rental should be kind of around inflation, which is 6.8%, maybe a little bit higher in some suburbs, but to virtually do double inflation is unheard of and unprecedented. Once again, great news for landlords, bad news for tenants. In terms of Melbourne rents by region, you can see the increase. So inner east, which is where all the money is, has gone up by 16.1%. So December 22, 650. December 21, 560. So quarterly change 8.3. Then you have Mornington Peninsula, which is a great area to invest in. And I've got a project in Mornington itself that I'll show you, which is entry level. Rents have gone up from 480 to 530. Southeast, 435 to 480. Northwest, 405 to 440. Inner, 600 to 650. In the south, 650, this is just in 2 years, 700. West, 390 to 420. See, not as much as the other suburbs because there's no money in the west. It's very much a cluster of blue-collar workers. So there's less money, less propensity to increase rental. Northeast, 420 to 450. Outer East, 470 to 500. So the biggest increases in Melbourne have been inner east, Mornington Peninsula, southeast, northwest, inner southwest and northwest. Guess where I'm sourcing all my properties for my clients? Inner east, southeast, northwest and inner. which means they've had the highest increases in interest in rentals in their property portfolio, which means they're very happy. Vacancy rates, 1.5%, ridiculously low. It should be 4.5 minimum, really 6.5 is the average. There are suburbs now 0.8%, 0.5. We're talking 6 to 10 houses, and all inclusive for the month. I mean, it's just, there's nothing, and you're having 100 people turn up at an open. It's just ridiculous. Number 5, Melbourne's property owners are holding on to properties for over 20 years in key suburbs, and some are not selling at all. And why should they sell? If they're happy where they are, why should someone sell? You don't have to just keep selling properties. No one says that you have to sell every 7.2 years, because that's what people have been doing for the last 50 years. So where are people holding on to properties for the longest periods of time? You have Melbourne inner. So Greater Melbourne's 9.9, which is 9.9 years. And that's median years, 12 months to December 22. I look at the comparison between 2002 and 22. So 20 years ago, the average house in Melbourne used to sell every 6 years. Now it's selling every virtually 10 years. In inner, 5.7 to 12.3. In inner east, 7.4 years to 12.9. In the south, 6.3 to 12.5. Inner east, 6.6, 10.3. Inner west, 5.8, 8.9. Outer east, 6.7 to 12.3. South east, 6 years, 8.9 years. Inner west, 5.1 to 7.9. And Mornington Peninsula, 5.5 to 11. So people are holding on to properties longer and longer. They're not selling, they're not upgrading, they're reaching their suburb that they want to live in, and they're just renovating their houses and spending all the energy on making the property perfect. So in Melbourne, the properties in the suburbs where owners don't want to leave, in terms of holding patterns, Vermont South, 22.3 years. And I know properties in Vermont South and Vermont that literally were purchased in the 90s or the 80s for 100 grand. Now they're worth $2 million, and they ain't moving at all. And the cool thing is, when I was at Monash University, where I wasted 4 years of my life drinking beer at the tavern and shooting pool, and doing assignments with international students that couldn't speak English, and the teacher said, it's not my problem. Thank you, Monash, for wasting 4 years of my life. In fact, I want to go back one day with my certificate and just say, hi, I did a business degree here. It didn't work. Can I get my money back, please? But you can't do that. There's no money back with Monash. But anyway, thank you for wasting 4 years of my life. But when I was at Monash, there was a theory that by the time the baby boomers, which is a group of 1 billion babies born after the Second World War, would mature and then retire at 65, they would sell down all the houses because the kids have gone. So imagine you've got a couple, they had 4 kids in Vermont South, they're on a 2,000 square metre block, they've got a 5-car garage, they've got a 5-bedroom house with 5 en-suites. The theory was, well, why would they want all that room and space and maintain the big garden and have all these garages where the kids who have gone, they're all independent, and what they will do is sell that house and buy a townhouse in the area, so they still want to have the same community, a 3-bedroom townhouse with a spare bedroom for the grandchildren to come over, and then they would live out their days travelling and enjoying life. It didn't happen, guys. It was all bullshit. What happened was those old people didn't go anywhere. The kids went, they're staying exactly where they are. They got a big house, 2,000 square metres, 5-car garage, and they ain't going anywhere. In fact, they're putting lifts in now in the eastern suburbs. I know lift companies that can't keep up with demand. They're not selling at all. None of them are selling. I love it. All those academics were completely wrong that did all the white papers in the 90s predicting there's going to be this flood of properties that will be unwanted by the baby boomers. They were all completely wrong. And I actually I've got an investment property in Vermont on a 1,300 square metre block, and I actually went to the neighbour because one day, a few years ago, we had a massive storms in Vermont, and all the fences fell throughout the whole suburb. We had like 190 kilometre winds. Anyway, the fence was about 20 years old anyway. It's an investment property, and my property manager rang me and said, look, your fence is basically destroyed, you've got to get a new fence, we'll get quotes for you, blah, blah, blah. I thought it was a great opportunity to go and introduce myself to the neighbours. So I went to a neighbour next door who's also got a 1,200 square metre block, mine's 1,330. And I thought, look, I'll introduce myself as a real estate agent, telling them if they want to sell, I'll buy the block from them, and I can combine the 2 blocks together and have a big, townhouse subdivision one day. Anyway, I went there. It was a massive house, and they were in their 70s, late 60s, early 70s, I guess. Very healthy-looking couple, retired, not working at all, just travelling the world. And I said, look, if you ever want to sell your house, they said, mate, we are never selling this property. Our kids have been trying to get us to sell for the last 15 years. We've done everything we wanted to this property. And the husband took me out to the back and he showed me, he had this massive detached garage, and he was actually restoring old Falcons, and he had 2 that he was working on at the moment, and that was his man cave. And he says, see, the secret of my marriage was I live here and the wife lives in the house. And he says, mate, I'm never leaving this. The only way I'm leaving this house is in a pine box. And why should he leave that house? He worked his ass off to get that property. Now, people say, well, young kids can't get into the market, and why should they have a big block of land like that? Because they deserve it. They work their asses off and they've got it. And that's it. This is what capitalism is based on. And this is why these properties in these areas, Vermont South, they're holding on to houses for 22.3 years. Eaglemont, 21.8. Carnegie, 21.7. Knoxfield, 20.9. Coldstream, Clarinda, all 20, Seaholme, St. Helens, Taylors Lakes, Watsonia North. Now, this will continue to grow and grow, which means there'll be less stock on the market in those suburbs, which means as an investor, you want to be buying in those suburbs because you're going to have less competition and less available stock, which means more pressure on property prices. And also, a lot of these suburbs have huge blocks of land, which will have subdivision potential later on, eventually when Melbourne becomes 7-8 million people. Definitely a housing strategy report will change in Melbourne, that's without question. Number 6, financial markets think the hikes are done. They're pricing rate cuts through the second half of the year. So if you follow the futures market on interest rates, you can see already they are telling us that the direction of interest rates in the future is going down, which means this is probably much as high as it's going to get. Maybe there will be another increase, maybe another 25 basis points or 10 or 15. But I wouldn't be surprised if there was just a small one and then a small cut, so a decrease by the end of the year to stimulate the economy and consumer sentiment. So I think we're looking at the peak of the market and the interest rates. Once again, no one knows. There's too many moving parts, but definitely the market is telling us, yes, this could potentially be near the peak of the interest rate market, which means if you're buying something today, with interest rates going down in the future and rentals going up, that property will turn cash flow neutral or positive very quickly. So when you're doing cash flow analysis, you've got to factor in these things as an investor. Not only factor in the worst case scenario, which is today, factor in increases in rates, increases in rentals, and also decreases in long-term interest rates. So this is why I think at the moment, while it looks like doom and gloom, I think it's a perfect storm of things that's happening at the same time. And number 7 is probably the biggest one, which is the biggest driver behind everything, is people. Without the people, there is no market. The Albanese government has reportedly planning to total 650,000 new migrants to settle in Australia by mid-2024, and 57% will be settling in Melbourne and Sydney. So remember, during COVID lockdown, we had no migrants coming in at all. I mean, you couldn't go anywhere, you couldn't fly, you couldn't leave your house. Thank you, Dan Andrews. And now we're back in business. We have a shortage of labour. Unemployment's fine, but we had a critical shortage of labour. A lot of tradies have gone to Queensland, and now we need to import tradies, we need to import skilled migrants into Melbourne and Sydney to get back and get the economy booming again so we can go back to doing the things that we love doing, which is enjoy life and enjoy Melbourne and Sydney for everything it has to offer. So definitely, those 650,000 migrants will have a huge impact on the property markets in Melbourne and Sydney, because by the time they get here, they'll get a job, they'll rent for a short term, and then they'll try to get into the market as soon as they can, because based on their psychology, rent money is dead money. So I guess the whole thing about today's video is you got to look at it as a glass half full or half empty. I look at it as an opportunity. I look at it as a glass that's half full, and then all I do is take advantage of the prevailing circumstances. Drink that water. Remember, most people are reactional. Smart investors respond, which is only 5% of the market. And you're going to be placing yourself, whether you like it or not, each one of these categories by default. Non-action is as important as action. So if you're not acting right now, if you're not investing, if you're paralyzed with a lot of information, you're missing out on an opportunity to make money. The more education you have, the more money you'll make. Remember, be fearful when others are greedy. Be greedy when others are fearful. Warren Buffett. Do the opposite of what everyone's doing. Now, I sent this email out just recently talking about when to get into the market, and this was in February 2019 with the bottom of the market, and I said the best time is to buy then. Then we had another February 21. Now, February 23, best time to buy. This is if you want to time the market. Now, I don't believe in timing the market because, ironically, there isn't good stock available right now, and borrowing capacities have diminished by 150,000 in the last 12 months for the average Australian employee. So you might get to that magical point in the property cycle, but guess what? You can't do anything about it, or there's nothing to buy. And you're going to be very disappointed that you've wasted all this time and energy planning for that moment to come, and you can't take advantage of it. So that's why I say it's timing in the market, not timing of the market. Buy whenever you can buy. And then when the market goes up, you just look really smart, like myself. Dollar cost averaging, guys, that's the key. Now, this is a video that I did a few years ago talking about the best performing suburbs. So the best performing suburbs that I'm focusing on right now is definitely Bayside and Inner South, Inner East. But I would say Blackrock, Mentone, Frankston South, Mordialloc, these have done 30% growth just now, and they're still growing. Albert Park, Karen, Parkdale, Belmorris, Frankston, Seaford, St Kilda, Sandringham, Asphodel. These are the suburbs that I'm spending most of my time and energy researching for my investors and sourcing townhouses from developers. Here are some examples of properties that I've recently sourced, just to give you some examples. And I've just chosen just a random selection of properties. This is a small percentage of what I have. I've got access to nearly 3,000 properties at any one time. This is a development in Mornington, which is a great suburb. It's done really well during COVID lockdown. It was a sea change suburb. It's only an hour and a half from Melbourne, but you feel like you're in paradise. I mean, look at the beach. It looks amazing. But you're still close enough to Melbourne that if you want to go to a sporting event, jump in the car, an hour and a half, you're back in Melbourne. No big deal. The area has grown ridiculously well over the last 3 years, 40% growth. So for Mornington itself, 12 months growth, 18.1, 3 years, 47.81, 5 years, 44%. Combination of sea change and just capital growth and limited stock. The project that I sourced is just here off Main Street. And this is the main drag there with all the shops, restaurants, cafes and hospitals. And obviously here you've got the beach. So it's a really well located property. It's an entry-level property. People sometimes complain everything that I source is 1.5 million. Well, here's a cheap property for 700,000. I get emails all the time. Konrad, everything you show us is 1.2, 1.5. We only can buy 700,000. Well, here's 700,000. So these are two bedders, entry-level, architectural design, great developer, great builder. We've done a lot of projects with them over the years that we've sold. Entry-level, so builder's range, targeting the young professional couple with no kids or the retired parent. As you can see, this is Mornington, lovely, and this is the main street there with all the shops, and it's just off one of the streets there. So you're basically walking distance to all the action. Couldn't get any better located than that property. Once again, the attraction is the beaches. Imagine walking down every night, walking your dog on that beach. Fantastic. These are two-bedroom townhouses, so they're all identical. So single car garage, downstairs you have a bedroom, built-in robes, toilet, storage under the stairs. Then you have open plan living, another bedroom, walk-in robe, built-in robe and an ensuite. Just over 103 square metres, 695,000, and they'll be completed by the end of 2023. So ready to be moved into. There's only a few left, and I had a few reservations in the last 2 days. So if you are interested, definitely email me and I'll send you the latest price list with all the information for that project. It's possible that by the time this video comes out, they'll be all sold as well. I've asked BMT to do an appraisal and cash analysis for this property, and based on the rental of $580 per week, the property was cash flow positive by $11 per week for an average income earner. And that includes rates of $1,800, property management fees, etc., all the insurances. that are associated with owning a property. So it's cash flow neutral to cash flow positive, depending on how much income you're earning and how much tax you're paying, which is a great way to be for your first property. In fact, with most of my clients, that's what I strive to do, is get them into a situation where they're buying a cash flow positive property for the first property. This is a development that we sourced in Port Melbourne. Number 2 and 3 was sold recently. It's about 3 years old. Number 5 is available, which is this one here. It's at the back of the suburb. Great location, very quiet, 3 k's from the city. It's a 3-bedroom property, so it's looking for kind of single parent or couple with 1 child, or single couple with no children, professional couple working in the city, 3 kilometres from the city, less than half a kilometre from the beach. Very well presented, great views, low maintenance gardens, so very low maintenance, high capital growth, 1.425 million for that one. And once again, Port Melbourne, great beaches, great cafes, great restaurants, very close to the city. This is kind of a bread and butter kind of a townhouse that I source for my clients. And look, Melbourne is expensive now. The median price is $960. So a good suburb, for a good townhouse is 1.5 million, basically. This is the ground floor. So you've got a courtyard, open plan living. You've got a powder room there, laundry, and then a level 1, open plan kitchen, island bench top. You have a dining area. Then level 2, you've got 2 bedrooms with a common ensuite, built-in robes, and then upstairs on the level 3, you have the master bedroom with a massive ensuite and a balcony overlooking the city. Amazing property. They rent very quickly. They're renting for $950 a week. Once again, capital growth, 6.57 over 12 months, 3 years, 38.27, 5 years, 28.64. The average over 10 years, 8.14. When I do cash flow analysis, by the way, I always use 8% for Port Melbourne as a conservative long-term capital growth potential. Because remember, Port Melbourne is still semi-industrial. There's industrial parts and there's non-industrial parts. So always, when you're doing cash flow analysis or projections, use the worst possible scenario. And then the numbers come out better, you just achieve your objectives sooner. So $900 a week, they're actually renting for $950 a week because rentals have gone up so much. Cash flow positive by $9 per week for that scenario, which is fantastic. So imagine having that property working for you, having $9 a week. And once you wait for a few years, you'll be able to get your deposit and everything out of that property, and the property is just running itself, which is incredible. And then all you're doing is collecting rents for the rest of your life. Now, I hope you enjoyed this video today. For some of you who want to take the next step, ultimately, whether you like it or not, you're going to be placing yourself in one of those 4 categories. Number 1 is the analytical compulsive information gatherer. A lot of my engineering clients are famous for doing massive Excel spreadsheets, paying a lot of tax and not taking any action and buying no properties, and happy to pay $100,000 a year in tax to the government, which is interesting. They want to get in the market at the perfect time, which will never happen, I can tell you. Well, the perfect time was last year in November, so you missed the boat again. It's not a good strategy just to wait and do nothing. The biggest thing is, for those who keep analysing the market, just buy something, get the experience. If you don't like it, you can always sell it, make money, as long as you buy in the right area, which will give you the methodology of where to buy. Get rich quick gambler always concerns me, because property is all about getting rich very slowly over a period of time. It's not a get rich scheme. So you're better off doing cryptocurrency or drop shipping through Amazon or something online, because definitely property is not the vehicle for you. The comfort zone investor are people that buy properties within 3 or 5 k's of where they live, because they know where the train station is or the shops are, which is an interesting approach to making money. If you happen to live in a good growth area, then you probably make some good money if you're living in Port Melbourne or St Kilda or Hawthorn. But if you're living in an average area and you're buying houses in an average area, then you're doing yourself a disservice, and I encourage you to get educated and learn about the areas in Melbourne that actually outperform the suburb that you live in. Because ultimately, you should be living in an area for emotional reasons, not capital growth reasons. And the active, savvy, educated investor are the people that I work with who are building large property portfolios. I've got clients that are buying the 7th, 8th, 9th, 10th property using our system, and the rents have gone through a roof recently, so they'll be back again buying more properties. The ones that haven't taken action, well, they're going to be watching the market again going up in value without them, unfortunately. So if you're interested in learning more, number 1 is I definitely encourage you to attend a live event. Especially if you're starting out, if you've got less than 3 properties, is a perfect way to get into the market. We roll live events here in St Kilda in our office. From time to time, usually we do about 10 a year, every kind of 6 weeks, called the Real Estate Investing Fast Track Weekend. They're limited to 55 people only, because we have only a 60 people event room. So it's 2 days with myself, Stephen McClutchy and Cameron Fisher. And just jump onto the website. You can check the latest dates there and check out what it's all about. But definitely, we've had amazing feedback from these events, and it's all live content of what's happening in the market, a lot of structuring, a lot of things on finance and asset protection. It's $47 per ticket, and you get a hard copy of my best-selling book, Australian Real Estate Investing Made Simple. For those of you who want to take things to the next level, I encourage you to get your hands onto the new online video course that we've created, where we recorded 30 hours of content last year from the Property Portfolio Accelerator Summit 2022. This is an amazing event. We had 10 speakers, 4 days, and it was just incredible. We had people in the room that had 5, 6, 10 properties, are saying they've learned more in those 4 days than they have in the last 10 years of education. So it was jam-packed, and we've condensed it down into 30 hours, plus a manual. You can get everything, watch it at home and chunk it into sections, $997. So definitely is the best investment you can make for $1,000. I mean, if it's going to make you a multi-millionaire, it's nothing. propertyriches.com.au/PPAS 2022 is the website to go to. And then finally, for those of you interested in working with me personally, feel free to book in a 60-minute free strategy session with myself on Zoom. And what I do is I turn an idea into a plan and action. So I work out where you are, where you want to be, and I'll show you how to bridge the gap between where you are, where you want to be through property acquisition. The plan is everything, guys. You've got to have a written plan with dates. If you fail to plan, you plan to fail. And it's just never going to happen by itself. It's never going to materialize magically. You've got to actually take action, and you've got to have a strategy. Most people spend their life going from A to B, and they waste so much time and money. And remember, you can always get more money, but you can't get more time. Time keeps running out. So you've got to use your time wisely, and you've got to spend your time efficiently. Rather than making your own mistakes, learn from the mistakes of others. All the mistakes have already been made. You don't need to make new ones. So what I do is I show you how to get from A to B with the least amount of effort, maximum achievement possible, based on my 25 years experience. It's a personalized 1-hour strategy where you walk away with a clear plan of action of what you need to do. I also give you an introduction to my whole team, my accountant, my financial planner, my lawyer, my mortgage broker, everyone that you need to make sure that you have a large property portfolio built for you by other experts. So just for that, it's worth going to the to having a strategy session with me. It's paint by the numbers, guys. It's step by step. It's very simple. Once you see the plan, it's very simple. I source the properties, the accountant does the structuring, Stephen McClutchy does the lending, the lawyer checks the contracts. I mean, couldn't get any simpler. You got to qualify though. You've got to be able to borrow at least $700,000, because I don't source properties under $700,000, generally speaking. The cheapest properties that I have access to now, pretty much $695,000, $685,000. So as the individual, you've got to be on about $95,000 per year and have about $112,000 in cash or $126,000 in accessible equity. It doesn't need to be your equity. It could be your parents' equity or a joint venture partner. But as long as you've got that income and you've got access to that equity, we can do a deal and I can get you started in property investing. As a couple, you need to be on about 140 combined with $112,000 in cash or $126,000 in available equity. And that will give you into a $700,000 property purchase, roughly based on today's serviceability. Now, this could change in the future. Disclaimer, if the RBA keeps increasing rates, but I'm saying right now, as a rough guide, this is where what you're looking at. Now, if you make more than that, have more equity, then definitely you can jump on and we can book a call. So for those of you interested, if you've been to live events, just fill out this form and email it to me. For those of you who are watching this YouTube video, just send me an email, conrad@investorsprime.com.au, and then I can have a chat with you and book a time in on Zoom. And that's about it, guys. I hope you enjoyed today's video. Stay tuned for other videos that are coming out soon. This is Konrad Bobilak, and I'll see you on the inside.